One of the mistakes that many investors make is that they look for the cheapest rate. And it's not really about the cheapest rate. It's really about mortgage product types. Now, there are three different camps of where mortgage products will actually fit into. The first is variable rates. So you'll find many mortgage products with variable rates. Now, variable rates work extremely well. We use these, and you can use these when you're purchasing property, where it's a tired property. And what you really want to be doing is you want to really then refinance and get it onto another product because you've added value to that property. And that's the key. So you've added value, and what you'll find is now you have a new higher value, so you refinance onto another product. And variable rates are great for this because with a variable rate, you might find that it's an easy entry level with that product. In terms of the lender's criteria is much easier. So you're jumping into it and you're aware of the market, because the market where the rates can be going up, they can be going down as well in certain parts of the economy, but typically they're going to be rising, right? So what you've got with a variable rate is you have a short time frame because you're only using it for that short time frame. Hope I'm making sense for you. The short time frame means you use it no matter what the rate is really. Because of that short time frame, there's only a minimum amount of capital expenditure and you're going to be moving that onto another product anyway. That's how we use variable rates. Let's now discuss the next camp. Hope you're enjoying these insights. Now, I'd love to hear your comments as well. You can click on that bell icon, get the latest notifications. Even I've worked out where that one is. And you can also subscribe to the channel. I'm doing a number of videos like this, informative, to help you to move forward in your property journey. And the next camp of types of mortgage products is actually having tracker rates. So tracker rates, just for clarity, means that there's a percentage added on to a base rate that that lender is actually using. So as the interest rates rise, your tracker rate, let's say it's an extra 1%, the interest rate for your mortgage will also rise by that extra 1%. And of course, if the interest rates are falling, in the same way, the interest rates will fall and you will pay a extra percent, a 1 or 2 usually percent of whatever the lender's rate is, and your tracker, as it says, will track that rate accordingly down or up in the way that's required. So that's the tracker rate. Right now, if I'm being completely honest with you, it's not one of our favorite products, but the tracker rates are there, so you can choose to utilize that. So if you're quite savvy with sort of having a bit of a crystal ball and thinking, right, where are the rates going, and you're willing to take a hedge on that, then the tracker rate can then really help you with that one, because you can really sort of predict in your own way of where you think the rates are going to be sitting, and the tracker will allow you to really maximize on that. Like what I say, it's not one of our favorite ones, but let me share with you the third camp, which is one of our favorite ones, and that is fixed rates. Now, what I like about fixed rates is that with fixed rates, you know exactly where you are. In fact, at Premier, what we do is we use this as an insurance policy in effect, because you will always understand what your fixed costs are going to be on a monthly basis. There's no ups and downs. You know what the regular amount is, and especially in a scenario where interest rates are tending to be moving up, you will find that having a fixed rate is really going to be beneficial to you. So what we do is we look for fixed rates, stability, security. You know where you are, and that's fixed rates. So there you have the three compartments of different types of lending when it comes to buy-to-let.